Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Well, episode 161 of Facts versus Feelings is here. Sonu, I looked outside and there's like 2 or 3 inches of snow in Cincinnati. I don't know if winter is here, is what we're going to call this or not, but winter is all of a sudden showing up. How's Chicago treating you?
It's cold. That's how it's treating me. It's cold. But I have allergies, and spring and fall are my worst seasons. Okay. So in winter, everything's dead. So I thrive. But it looks like the market's thriving too. How's that for a sec, right? The market's thriving as well.
No, that's a good way to put it. I mean, there's so much to talk about. We're going to dive all in. Let's start with the government potentially reopening, right? We're recording this on, what is today? The 10th, November 10th. It sure looks like the government's going to be opening sometime later this week. The market is popping nicely on Monday. We're going to talk about last week and the sell-off and tech stuff. But what's your, how excited are you? Let's be honest. Let's amongst friends. You haven't had a bunch of economic data to dive into like you normally do for 41 days or so, 42 days. Yeah. How excited are you? Look at that smile on the YouTube channel. How excited are you that the government's going to open up and you're going to finally get to look at some data again?
Dude, the hard part is like, what am I going to focus on? Which piece of data? It's all going to come out, right?
We're going to find your favorite real fast. Which one do you go to first?
I know there's inflation, there's durable goods, there's industrial production, there's retail sales, payrolls, all of it.
I mean, it just sounds terrible to me, but I'm glad you're happy.
As some of our listeners may know, I write a daily note, and usually on a typical week, right? Whether we have macroeconomic data, we always have some macroeconomic data. Yeah. If I count all the charts I put in my daily notes over 5 days, it comes to about 70 to 90. I have gone to like 100, 120 charts once in a while, but usually about 70 to 80. I've been running short. Right. And by short, I mean, it's more like 40 to 50 charts, which is probably still a lot. But, I've stolen some from YouTube. But I feel sort of like there's something missing inside me.
You miss the government. That's what it is. And people ask us, I get this, hey, how, that's we call it Sonu's Daily Note, which again, he really dives in. People say, how can I have access to that? Become a Carson partner. That is how you can do it. Join up with the Carson group if you're a financial advisor.
Many.
That's the top reason. Join up and you get a lot more in-depth detailed research from the research team, but also from Sonu. But Sonu, it looked like it took 14 votes of no's. Finally, on the 15th vote, apparently with the Senate, we're going to have a yes. There were 8 Democrats that broke ranks. I guess that's what we call it. I don't know. Yeah. It's kind of like tariff. You always slap on a tariff. Well, apparently in this particular case, it's broke ranks regarding voting on this whole government shutdown and funding the government. Now, 6 of the, I thought this is politics, and six of those 8 are not up for re-election, and 2 of the 8 are actually going to retire.
Yes. So that's including my senator, by the way, in Illinois.
Oh, really? Okay.
Dick Durbin. Okay. Because he's not. So I think usually the stuff is on the axis of, okay, how far left or how far right? Who's in the center? Maybe the center is, but this time it was not quite that axis. It was like the folks who are retiring don't have to worry about facing, Democratic primaries anytime soon. That was the axis under which. Look, I think this is not a surprise. I think even before the shutdown, I've been saying once the election's over, one way or the other, things will come to a head, and this will be resolved. And last week after the election, I sent out a tweet saying,
you did.
Within a week, I think the shutdown will be over. And over the weekend, I was like, maybe I was wrong because it doesn't look like anyone is compromising. Then boom, Sunday evening, it all came.
It all happened. And, Right in time for futures. Right in time. And I don't know if you put your tinfoil hat on or not. And I just want to preface this. I don't like talking about politics. I know you don't either. You know, some of the early is, the Democrats caved. I don't know if they did or not. I'm not going down that rabbit hole. Yeah. I just know that we did have multiple, over 120 different elections last week. Democrats did really well, right? And so they did that. Obviously, won Virginia and New York City mayor, and what's the third?
Jersey.
So Democrats did very well. So I don't know if the government shutdown helped them or hurt them, but they did win some of those off-year elections. So that's kind of where we are.
Look, 6 months from now, maybe even 3 months from now, nobody is going to be talking about who won or who lost, or we'll all move on.
That mayor of New York's pretty hot subject, though. That one, people I still might talk about that. I'll just leave it there.
I meant the shutdown.
The shutdown. Yes. I got you. Okay. Right. Yeah. Well, we still might remember the shutdown. There's been a lot of friends. I've heard a lot. Jim Cramer, big fan of Jim. I mean, he was talking about his just disaster of the day at the airport. A lot of people have been struggling. Yeah, fortunately, I was in New York last week. That had a lot of fun running around, and I was at Newark, and I timed it. I was like I don't know, 2.5 minutes is all it took me to get through. Really? I was worried. I got there really early. I was texting you, so I might be stuck in New York. But clearly, once these airports started showing what was happening, that really seemed to push everybody.
Imagine we went into Thanksgiving like that.
Oh, no. I mean, well, you can be blue, you can be red, but nobody likes waiting at the TSA line. And again, shout out to all the TSA people that have worked for over a month and not gotten paid. I was thinking, I'd do this job, not get paid, but I wouldn't know I'm getting paid eventually. I don't care who you are.
And flight controllers, right?
Yes, flight controllers and all that stuff. So thanks, everybody, to do that. Hopefully, by the time most people listen to this, we'll be opening up. And I fly this Thursday, so I'm hoping everything kind of gets back. Now, can I
put another wrinkle in here? So
let's do it.
Continuing resolution goes up until January 30th.
Yeah, I figured you were going to say this. Yeah, okay.
So we could be doing the same thing again February or March. Hopefully not. I hopefully it goes past that. But just putting it out there.
Yeah, no, that's fine. So, some other things to think about here. If you look at kind of how Democrats did quite well in some of these off-year elections. Our friend Libby Cantrell over at PIMCO, and hopefully you remember the exact dates. There was 2000. I actually remember. It was 2009. The Republicans did much, much better in the off-year elections. 2010, they won many seats, like over 40, I think, 40-ish seats.
2010, yes. Yeah, 61, I think 63 seats or something like that.
Okay, then you fast forward to 2017, 2018, when the Democrats did much better, and they won low 40s seats. So Libby, Libby does great work, and she pointed this out, that maybe, just maybe, this is a sign the Democrats are going to win maybe even more seats than normal. This isn't political, everybody. This is just the facts. This is facts versus feelings. The facts are the party that loses the election is usually more motivated. They do better at midterms, right? We'll just keep that high level and simple.
And that happened even in, I was looking at your numbers that you shared this morning on a call with our advisors, 92, 93. Like this was, after Bill Clinton came into power, 94 Republicans won this big election. They won the House majority for the first time in decades, I think.
Okay.
And then again in 81, 82, if I remember right. I don't have the chart in front of me, but I think 81, 82, Reagan had won the election against Carter. And guess what happened? Democrats won. They were in charge of the House, but they won even more seats.
Right. So we'll talk a lot more about this stuff. But let's say this is what I believe a 5-seat majority for the Republicans in the House. Yeah. Maybe a good chance for the Democrats take back the House, but maybe not so much the Senate, right? And that would give us a split Congress. Just so everyone knows, we've talked a lot about this. I remember talking about this repeatedly over the past several years. The last 13 times, Sonu, we've had a split Congress. You know what's happened? The S&P 500 has been higher. Now, there's lots of other factors, but I think gridlock is good. I think last November when the market rallied like crazy after President Trump won, it wasn't so much because he won. They looked over at the House and said, ooh, that's some gridlock, right? All the spending and all this stuff in red or blue, everybody. This is about spending, and whichever party has too much power, then you spend too much. So those are some really interesting concepts to think about. That should we have a midterm year? Should we have gridlock after everything's said and done? Historically, markets actually like that a whole bunch. Anything else you want to add on that before we get thrown with a shoe by talking too much politics on this podcast?
No, I think maybe a seg into sentiment, right? Because that's always, connecting this to politics. I think America's always in some mood of throw the bums out. No offense. But, one party is in power, you throw them out, put the other party, they stretch too far in whatever direction, throw them out as well. And then the pendulum swings the other way. But overall sentiment just seems so poor. We were talking about that. And I think inflation is a big piece of that. And when I think about inflation, I'm thinking about like the economist definition of inflation, the rate of change of prices, right? I think for most normal people, well, I don't know if I'm normal in this. Maybe
so you literally said you're missing diving into like the JOLTS data. You're not normal, okay?
I'm not normal. You're not normal. But most normal people be like, prices are going up, that's inflation. Prices are not going down, that's inflation, right? Prices went up a lot in 2021, 2022, and prices are not going down. President Trump ran on that.
Yep.
And I think Democrats ran on that as well. And I think that's a big reason why sentiment is in the toilet.
So you think about it. I mean, one thing you're talking about, that Michigan consumer confidence number came out on Friday. It was like 50.3, I believe, the second lowest number we've ever seen. So let's put some context around it. The lowest ever was June of 2022. So according to this one particular sentiment poll of how consumers feel, people actually feel worse now, Sonu, than they did during the tech bubble implosion, during the great financial crisis, and during a 100-year pandemic. It's hard for me to really feel like that's true, because I remember the GFC every Friday looking around like your buddy's getting fired, somebody's getting fired over here, getting fired over there. I tried to get a job after the after the tech bubble burst when I was in college in the early 2000s. That wasn't very fun. And the 100-year pandemic, my goodness gracious, that was really frightening for a while. So again, but then you look in history, when you have lowered expectations, lowered sentiment, you can get better. I mean, June of 2022, that's the lowest this Michigan consumer confidence number's ever been.
That's amazing.
That is when the stocks bottomed. Now, I know the stock market bottomed in October 2022, but go back and look, everyone. More stocks bottomed in June of 2022. So you could argue that's when the market bottomed, just much like October 2008, most stocks bottomed, but it wasn't until March of that next year when the stock market bottomed. Different ways to slice this. But the reality, that wasn't the worst buying opportunity. Looking back, how much we're up since June of 22. I still am bullish because of that. What else on that Michigan consumer confidence struck you? Want to talk about anything else on that one?
I mean, I'm still like, I don't know, gobsmacked. By how bad people feel.
Wait a sec. We've done 161 of these. I don't think we've ever used the word gobsmacked. I don't know. I'm not sure if we have, but this is I like it. I like it. Yeah.
You can tell I'm going through data hangover here. Hopefully that ends soon. But look, the University of Michigan Index. It's a very old survey. Okay. It's got data going back real decades, right? So it's a very good survey. But it's very colored by politics, right? Yeah. Between Democrats, once the election is done, suddenly Democrats felt really bad. Republicans are feeling really good. That reversed what was happening over the 4 years when Biden was in office. And even before that, in Trump's first term, we saw the opposite, right? So, but even conditioning for that, if you just look at independence, the data doesn't look all that great. Sentiment is still poor. So the index is constructed of two components. One is something called the expectations component. It's like, how do you expect your finances? How do you expect the economy to be, in the future? And that's been low for a while. We're close to the lowest level in the cycle, but that component generally been weak for a few years now. But the component that was holding things up was this other piece called the current conditions index. How do you feel about your situation right now? That was okay. Even over the last 2-3 years, it just collapsed. It collapsed to the lowest reading ever, including 2008, to your point, right? If you ask people, basically the survey is saying, when we ask people, how are you doing today? They felt worse today than they did even in the depth of the financial crisis.
I don't believe you. I don't believe you. That was pretty terrible if you were around back then. That was not a fun time.
But I think this is where that inflation piece is just frustrating.
Yep.
Hurting to an extent, but we know that inflation's pulled back, right? Inflation was much worse, like measure it any which way. Surely inflation was much worse in June of 2022 than it is right now, right? But I think people are just annoyed and frustrated that prices haven't gone back down. And I think that's essentially, inflation impacts everyone. Unemployment doesn't impact everybody. But I think that's essentially why we're seeing sentiment as poor as it is right now.
So if you, great stuff. If you identified as a Democrat, you were 33.2% on this confidence for the Michigan consumer confidence. Republicans, 91.9%. And independents, 45, kind of near that middle. So, and again, It's politics. Yes, it was the opposite, during the last administration. So that's just kind of where we are. I did see there's an op-ed piece over, I guess it was on November 7th. And I'll make sure I read it correctly because I don't want to miss, but it was from the New York Times and it wasn't very optimistic. So let me see here. It said, here it is. Okay. It was a guest essay, what it says.
Okay.
Trump is pushing us toward a crash. It could be 1929 all over again.
Did he give a timeline? Did he tell us when?
I didn't read it. I didn't want to pay the money to read it. I don't know. Anyway, but it had like Trump wearing like a top hat and like one of those like little eyeglasses, just the one, like almost a Monopoly man. So he looked
ready
devious.
To crash things.
Devious is what I'm going to use. So that's out there now, David. We can show the AAII sentiment poll chart just so everyone knows. These are reasons this is a hated market. I'm not saying it's the most hated ever, but you don't usually see people talk about this is 1929 when you're pretty much at all-time highs across the globe. But that's where we are. I mean, that's where we are. And as you see on the YouTube channel now, Sonu, this is extremely rare. So far this year, we've seen more than 10% bears than bulls. Now, the year's not over. I get it. But we're up like 15, 16, 17% on the S&P 500, approximately. 3 years in history have we seen more bears than bulls like that for the full year. 1990, 2008, 2022. All down years. And if you remember some of those years, 2008,
recession or
22,
inflation, right?
Recession, inflation, just devastation for an equity investor. Yet people feel the same now as they did those 3 years. I mean, it's hard to think. I think a lot of it has to do, maybe they've invested in crypto, maybe they've invested in AI, which is honestly done well, but it's more volatile. I don't know. But I mean, that is fascinating when I see things like that. And then we see Michael Burry's back. He's all buried up on, stocks like, not a recommendation, like NVIDIA and Palantir. What else did we have? We had the two big CEOs at the big banks last week talking about, hey, yeah, it'd be perfectly normal to have like a bear market real soon. I mean, that was just like a conversation piece. Like, oh, that's
put some context around that. You've done the work, right? Is it really? It's not that normal to have a bear market, every so often. I mean, we've had couple of them over the last 5 years, but usually bear markets happen once in 3-4 years?
Every 3.5 years on average.
3.5 years,
but again, no such thing as average. We've seen a couple bear markets just since this decade. The other one that gets everybody all riled up, Buffett has record cash. Now, that's on a nominal basis. You got to look at different things, but that's out there. So that's the stuff that, like, we know listeners this have. We work at the best financial advisor in the industry at Carson Group. When their clients are hearing this, it's all we're hearing. And then you hear how it's top heavy, right? There's only 7 stocks going up, which we've pushed back extensively. I don't believe that. That's not true. Year to date, like all sectors, excluding staples, are up on the year. That's the group I'd want to see lagging. It's not just that. Even the equal weights. Everybody says, the equal weights are underperforming. Yeah, they're underperforming, but not by that much. I mean, equal weight stocks across the board are higher. So it's just, it's fascinating to me. I mean, from this big kind of science experiment, why do people feel so truly bad when the economy is not that bad? There are people struggling. We're not minimizing it, but the stock market's up a whole bunch. It's I think it's wildly bullish to be blunt to see this rally, this market so hated. What else you want to talk about on kind of that angle of things? Sentiment.
The vibes ain't good, right? But you know who recognizes that? I mean, you have to give him that, is the president.
Yeah.
I feel like he's got a pulse on, how people feel, and he knows like things haven't gone well, and he was the first to admit after last week's elections that, things didn't go well for the Republican Party. So he's out there, this again, speaking of Sunday evening, before futures open, he's out there tweeting, you know what? We are the richest, most respected country in the world with almost no inflation, record stock market price, 401ks are the highest ever. We're taking in trillions of dollars. This is presumably from tariffs. So a dividend of at least $2,000 a person, not including high-income people, will be paid to everyone. So, but I think that's his way. And most politicians, if they're faced with, I think voters mostly who are complaining about prices, like what do they do? Demand side stimulus, right? Yeah. Send a check to, now it doesn't help because now we have an inflation issue. It's not like the old days. You send a check and inflation doesn't get, inflation doesn't pick up. But now that's not the case. But yeah, it's interesting that they're pushing that demand side stimulus. Like, you're going to send out checks. Now, I don't think that's going to happen in reality because President Trump cannot send out checks by executive order. He's going to need Congress As we all just saw, Congress can barely get its act together to keep the government open. So I don't think they're on the same page with respect to sending stimulus checks. But it gets to intent, right? I like to think of this as don't fight the White House. Just like don't fight the Fed. If the Fed's easing rates, that's a boost for the stock market. It's a tailwind for the stock market. Don't fight the White House. The White House, I think, is deeply interested in keeping markets running as they have pretty hot, right? I think if push comes to shove, they will probably put their hand on running the economy hot as well. Even if, yes, there could be some inflation, but they'll try to solve that problem by let's just give everyone checks. Let's give some money to, solve that problem. But I think, look, if the economy, if the stock market's running hot, you want to be in it. You want to ride that.
Mm-hmm. No, well said there. Speaking of hot, Monday, I'm assuming there's 30 minutes to go. The S&P is up 1.5% the time that we're recording this. So I'm going to assume the S&P finishes higher this Monday. Something bad happened if not. That'll be 10 Mondays in a row, Sonu, that the S&P 500's been higher on Monday. I remember I've shared this a couple weeks in a row because it's easy data. I update my charts. And I mean, so many people mocked this literally last Friday because everybody's bearish Friday. I want to talk about last week's action very soon, but everyone mocked it like, it's not going to be up again, not going to be up. Now we're like have one of the best days of the year. I mean, literally, like the time we're doing this, up 1.5%. And one of the best days of the year on the 10th Monday in a row. And of course, it's because some of the bad news has been leaked out on Thursdays and Fridays, and then by Sunday afternoon, Sunday evening, we get good news and the market rallies. Now, let's talk about last week for a minute, Sonu. You think about it, the S&P was down 1.6%, 1.7%, depends total return or not, but we'll call it, a decent down week. The worst week for the Mag 7 since Obliteration Day, Liberation Day back in April. But you peel back that onion, this thing you and I talked about with our Carson partners this morning. 8 sectors were up on the week. 7 of them maybe 7 sectors up on the week. 8 of them outperformed the S&P 500. It was tech and tech adjacent and consumer discretionary that lagged. That's Tesla, big part of that, and Amazon, big part of that. But there were a lot of stocks that went up. Now, David, we can share the other chart that I sent to you. It's looking at the S&P 500. It closed, it found support right at the 50-day moving average. But what gets me as a technician at heart, last week there were more stocks above their 20-day moving average by Friday than there were at the start of the week. There were more stocks above their 50-day moving average by Friday than there were at the start of the week. The number above the 200-day was like right at 60%. That was flat. So what I'm getting at, there was participation. There were stocks participating. Listen, those big ones that are a big part of the market, they had a pretty rough week. Now they're really bouncing back on Monday, the time we're doing this. By the way, gold's bouncing back too, which is kind of nice. But anyway, to me, I hear these things like Hindenburg Open. I don't want to spend a bunch of time on it. It's this thing they're trying to scare everybody with, where a bunch of stocks make a new high, a bunch of stocks make a new low at the same time. Yes, we saw Hindenburg Opens before the 73, 74 bear market, before a great financial crisis, before 87, literally right before COVID also. But the truth, again, I looked and you see these signals all the time. I mean, literally, like if you bought every time you heard the word Hindenburg Open the last 10 years, you'd be doing really well. So we're not minimizing it, but I think it's just you need to look at a lot of other things than just one signal. And to me, there's still a pretty healthy amount of breadth. And last comment, and then go to you, Sonu. Just look globally. Like today on Monday, Europe is soaring. I guess Europe likes the fact we're opening up, or we're just in a bull market, okay? I mean, literally across the board in October, a couple of weeks ago, just about every global stock market closed either at a monthly all-time high or a 52-week high on a monthly closing basis. The bottom line, this is still a bull market. There are worries, there are concerns. We don't think it's over. The first half of this November has been kind of choppy. I wouldn't be shocked at all if last Friday, when everybody's freaking out about whatever we're freaking out about, and then we had a big reversal down 1.3%, finish in the green, broke the 50-day, closed above the 50-day. I looked at some of those things. You tend to have strength after you see that washout. It's still a bull market, and I think November might have hit the lows, honestly, on Friday. What do you want to go on what I just said or anything else? What do you want to do?
Actually, that global market thing, I mean, that global reflation trade, right? Global markets doing well, global economy is doing relatively better than they have. Mm-hmm. That's a tailwind for U.S. companies as well. More than 40% or just about 40% of S&P 500 revenues come from outside the U.S. Okay. And I was just looking at earnings. So revenue growth for Q3 overall for the S&P 500 companies, it's supposed to be about 8.3%, which is really good, by the way. Mm-hmm. And if you look at companies with more than 50% of their revenues coming from outside the US, that's actually 10%. That's above the overall average. You look at earnings growth, profit growth, overall S&P 500 expected about 13%. By the way, that's much higher. I think at the end of September, expected earnings growth for this quarter was something like 8% or 7 or 8%.
Yeah, 7.9. I believe 7.9 on the last day of, get real precise, 7.9 on the last day of September. Now it's 13. Right. How about that?
Yeah, and now 40 days later, it's 13%. But then you look at companies with more than 50% of revenue coming from outside the US, that's at close to 14%.
Wow.
Right? That's a global story. Again, don't fight the Fed, don't fight the White House, don't fight a pickup in global activity, global economic momentum.
And momentum, we talked about momentum literally last week on the podcast. Yeah. And you mentioned, so whatever. I mean, that's interesting. It's right about when the government shut down, literally October 1st, so 40 days ago, from that earnings data. Mm-hmm. A week ago, well, yeah, we're recording this on a Monday. So a week ago, S&P 500 third quarter earnings were supposed to be up 10.9%. Now they're 13, just in a week. Just in a week, we saw that. And everybody keeps telling us, well, it's because tech's doing well. Yeah, tech did great relative to what was expected. Mm-hmm. Financials actually the big winner. Financials are even better than everybody. But a bunch of earnings last week we had, those weren't just tech names. In fact, most of the big tech already reported. So if earnings jumped from 10.9 to 13 in 1 week, what happened? Well, whoever reported had good things to say. And I think it's a broad-based rally. I'm definitely going to talk about the K-shaped economy very, very soon, maybe next. But earnings drive long-term stock gains. We sound like a broken record. We've said on this very podcast for 3 years, well, not 3 years, it's record earning, but for over 2 years now, with record earnings, new cycle highs and profit margins, those are the dual tailwinds to a bull market. We're still seeing it, okay? And I think that's important to remember. Anything else on earnings, or want to go to that K-shaped economy?
Yeah, let's go to the K-shaped. I mean, I'm like wincing as I think about K-shaped.
So I'll set it up in eternity. Yeah. So when you hear myth busting and K-shaped economy, when you hear K-shaped economy, what they mean? Think about a K. It goes two ways. It's arguing that some people in the economy are doing really well, and some are really struggling. And you look what I think it's pronounced Kava said and McDonald's said. Some of these honestly, look at restaurant stocks. They're struggling. The fast casual, I should say, and Chipotle, they're struggling. And they're saying, listen, the dynamic of the 18 to 25-year-old, they're just not spending like they once were. And they are struggling getting jobs. There are some cracks out there. The other side is the people that fly in first class. The plane's always full in the front. People are paying whatever they want to pay to sit up front, but the back of the plane is struggling. That's when we say a K-shaped economy, what we're seeing. And it is real. Now, the truth, we're stewards of assets. We manage almost $7 billion in the Carson Investor Research Team for our financial advisors and their clients. We pay attention to this stuff, but we are stewards of assets. We care about the aggregate. What is the economy going to do? We're not minimizing the K part that's struggling. But at the same time, what's really moving the economy? It is the top, the top 20%, top 20, top 30% of the economy are spending and growing and honestly benefiting from this bull market in equities and in the housing market. So I just said a bunch. What'd you find when you looked into busting some myths about that K-shaped economy?
Hey, I don't mean to sound club here, but maybe I will. All right. Let's say the economy has always been K-shaped. And so, people have been talking about, 2010, 2012, remember we had Occupy Wall Street and all. That was about a K-shaped economy and inequality. It's always been with us, right? You've seen charts from, I think the 1980s about CEOs making this much and the workers making much less. And, labor share of total income in the economy, that's gone down, relatively speaking. Margins have gone up, which is basically capital share of, national income. So it's always been K-shaped. So the question is, are we more K-shaped now than before? And I just don't think we are. I honestly don't. I hate to bring up names, but I will. Mark Zandi did this chart, and Bloomberg's put it up, and a lot of folks have put it up, saying the top 10% of income earners, they account for 50% of consumer spending.
Okay.
Turns out that is just wrong, right? There's no two ways to put it. The top 10% receive about 30 to 40% of disposable income. If you think about overall, $100 of disposable income in the US, about $30 to $40, let's say about $35 is received by the top 10% of income earners. And on top of, so it's definitely not 50%, right? They earn about 35% of total income. Okay. But on top of that, they save more than everybody else simply because they can't spend it all. They save about 25% of that, right? That's well above the national average savings rate is about 7%, something like that. So then when you account for that, their share of consumption clocks out around 30% or so, right? So it's definitely high for sure. 10% of income earners accounting for 30% of consumption, but it's not 50%. And these things haven't really changed over, they don't just change over the last 1 year or 2 years. They take decades to move, right? So that's the reality of it. So that's one. The other thing is, David, maybe we can put this chart up on the K-shaped economy. It shows the S&P 500 going straight up, or kind of straight up.
I'll just jump in. So this chart we're sharing on YouTube, I mean, it was everywhere. Like it was everywhere over the past 10 days. Go ahead.
Yeah. And, there's any number of, I think, chart crimes there because the other side, there are two lines there. One line is the S&P 500. The second line, the blue line, shows total job openings. And somebody smartly put, 2022 November is when ChatGPT launched. And since then, the S&P 500 has gone straight up. Since then, job openings have come straight down. Right? Oh, gosh. So look, the economy is growing. First of all, like you said, we are worried about the aggregate. That's usually what we focus on. I think with good reason. Aggregate, makes sense, right? The economy is growing, I would say, around 2.5%. Consumption slowed for sure, but that shouldn't be a surprise. Payroll growth has slowed, right? You think about aggregate income. Where does it come from? Payroll growth, wage growth, and hours worked, right? Okay. Hours worked is sort of slightly soft, but nothing crazy. Nothing like if it's a recession, it would be much lower. It's not that. Wage growth is still fairly strong. It's running above the pre-pandemic trend, at least in aggregate. So what's slow? Payroll growth. And we know that's because in large part, because immigration's come down. And that's why we're averaging maybe 30, 40,000 jobs a month instead of 140,000 jobs a month.
Okay.
Right? By that itself, you would think, okay, aggregate income is coming down. And I think that's what's happened. Fewer people are getting new jobs, getting new paychecks. And that's why I think restaurants have seen growth come down. You just mentioned it, right? Restaurant stocks, hotel stocks, things like that. But then you think about the stock market gains, right? It's gone up. You and I have talked about this. A lot of that has come on the back of profit growth, right? Inflation did boost nominal GDP, and that boosts revenue and sales, but companies are able to pass on those costs, and they boosted margins, right? So we've seen the charts, so you've shared that a year or two. Then on the labor market side, yes, job openings have fallen. Usually, historically, we've seen job openings fall and the unemployment rate has gone up. But for 2 years, you and I have been talking about this. Job openings have gone down, but the unemployment rate hasn't gone up.
Right.
In fact, over the last year, job openings have actually been flat. And because I forget who drew the K, they've sort of covered up the fact that over the last year, the blue line job openings have sort of flatlined. It's not going down anymore. All this to say, I don't buy this whole K-shaped thing, at least, not any more than what was already K-shaped, right? Yep. I don't think the K is getting worse. I'll put it that way.
Okay.
Anyway, that's I've said my piece.
You've done it. You've officially done it. Busting some myths with Sonu. Totally changing gears because that was kind of heavy stuff.
I know. I feel happy.
No, it's all right. It's all right. No, it's good. It's good stuff. I mean, I definitely want to talk a little bit more about the Challenger Gray and the initial jobless claims in a second, Sonu, but we'll have some fun with this one. Our friends over at Bespoke do just such great work, and they've done some stuff like crazy stats with sports. And I didn't know this. This is wild. So there was an 18-inning game in the World Series, Game 3 of the World Series this year, a week or so ago, right? It went to like 4 in the morning Eastern time, whatever. It turns out that Brad Paisley, country singer, he sang the national anthem before that game. Okay, well, whatever. That's fine, whatever. Sonu, there was actually another 18-inning game, Game 3 of the 2018 World Series.
Oh, also Game 3.
Game 3, 2018, went 18 innings. Brad Paisley sang at that one.
No way.
I mean, what? You can't make that up. I was like, unless I was like, maybe never let him sing again. Then again, that's a lot of money. That's a lot that's a lot of money. A lot of commercials. So Brad Paisley, everybody, might be singing a lot more at a lot of these sporting goods or sporting events. And if he does, just plan on leaving early. I'm like, whatever, I'll stay till whatever. But if Brad Paisley sings, apparently they go a long time. So
maybe they should have him for. Has he done the Super Bowl yet?
Oh man, I don't know. I mean, we need to look this up. But shout out to Bespoke. We cite them a lot and read their research. I thought that was a pretty cool one. So I know you've got something going on here. We'll wrap this up in less than 10 minutes or so. The other thing last week, the Challenger Gray and Christmas, right? Or
yes.
What order does it go
Challenger Gray. I originally thought Challenger was. It took me a while to realize Challenger is the name of the person or company.
Right.
Challenger Gray and Christmas, right?
Yeah. So it sounds like a law firm. Sounds like a law firm. But that came out that showed a lot of people potentially lost their jobs in October, like the most we'd seen since 2003. And similar to kind of the myth busting and the things that just really get everyone's attention, that soared. Now, let's be honest, we're not getting a lot of government data. We're not getting the monthly jobs numbers. We're not getting weekly initial claims. So I want you to talk about that. What did you see? Should we be worried? I mean, there have been some high-profile layoffs. I mean, these tech companies have done some high-profile layoffs, and some of that must have shown up, I guess, in the October numbers with the Challenger Gray and Christmas report. What'd you find?
Of all the things I worry about, that is probably kind of low on my list.
Okay.
Irrespective. Yes, they came out and said the October report did show a pickup in layoffs to 153,000.
Okay.
Now, the thing is, this report tracks layoff announcements. Mm-hmm. And this is companies' intention. They may come out, Amazon may say, over the next 6 months, we're going to lay off 50,000 people. Microsoft may say, over the next 3 months, we're going to lay off 30,000 people. It's all counted towards this month. Or somebody, UPS may come and say, we laid off 15,000 people over the last 7 months or something like that. Right? That's counted as October. Okay. That's what they're tracking. They're tracking layoff announcements. Year to date, companies have announced about 1.1 million job cuts. That is the most in terms for the first 10 months of a year since 2020, right? It's 65% higher than we saw in 2024. So by itself, yes, that is larger. But you have to look at the other side too, hiring, right? So even on the layoff front, technology sort of led. Technology companies announced 33,000 job cuts in October. Year to date, they've announced about 140,000, right? And they're saying it's stuff like, AI-related restructuring, slower demand, we're trying to become more efficient, things like that. Then you look at hiring plans, also announcements, right? This is the part that's never sort of cited or quoted in the headlines. Technology companies announced plans to hire about 250,000 people in October, right? They announced 33,000 job cuts. That made the headlines, but their plans to hire 250,000 people did not make the headlines, right? So anyway, all this to say, be careful with this stuff. And we haven't gotten the JOLTS data in a while. So JOLTS is Job Opening Labor Turnover Survey. And every month they tell you how many people were laid off over the last month. In August, which is the last month for which we had data, 1.7 million people were laid off in August. Now, a lot of people got hired and things like that, but 1.7 million people were laid off. That's just 1 month. If you take Challenger, Gray, and Christmas, this year and last year, it just about adds up to 1.7 million total. Whereas the actual BLS data shows that just in 1 month, $1.7 million people got laid off, right? So just some perspective there. I think what I would track instead is jobless claims.
Okay.
That's probably one of the best leading indicators for the economy. And as of the week that ended, November 1st, initial claims rose to 228,000. That's now much higher than what we saw in 2023, 2024, thanks to our friend Guy Berger to, he collects his data from the states, even though the Department of Labor is not releasing the official data for initial claims for unemployment benefits. The states still publish that. It's just so the Department of Labor.
Let me just jump in just for a second, because that's the Thursday number. The Thursday morning, sometimes Thursday morning's kind of slow. Everybody freaks out about it or not. But we haven't been getting that since the government shut down. Now, you're saying, we've had Guy, we've done some things with him before. He's awesome. You said he actually goes to the state level, all 50 states, adds it up, and it's pretty much the same thing. I mean,
Exactly.
So, and what's Guy saying? The last month. I mean, what's he seeing? Is he seeing a tick up in initial jobless claims or not?
Not really. Initial jobless claims are still hovering around 220, 230,000.
Yeah,
Goldman does this as
where
well.
We were. Okay.
And I look at both, and doesn't sound like layoffs are increasing. Where, you get continuing claims data too. Continuing claims is like, okay, how many people are continuing to receive unemployment claims benefits? And that tells you that, okay, these are people who've been laid off. If they are continuing to receive benefits, that means they're having a hard time finding a job. And if that starts to tick up, the hiring environment is weak. That's relatively on the higher side compared to 2023, 2024. But we know that from the other data. It's a low hiring environment, but it's also a low firing environment.
Well, we've talked about that for, it feels like 2 years now. Low hiring, low fire. 22 was crazy. Everybody got a new job then, but it's definitely slowed down a lot. Okay, so that's interesting. How soon do you think we'll start to get assuming the government opens up on Wednesday? I mean, I don't know if you know this. Will we start to get it like the next week, you think, that initial jobless claims data?
I think the next week. I mean, I don't know if you'll get Thursday data if the government opens up.
Probably not.
Yeah, but we'll see. I mean, there's, we may start getting September data. Remember, we missed all of October, so they haven't even done the surveys for October payrolls, things like that.
Let me jump in there. That's an interesting point of view. Let's say a lot of that data that's already at this point old, right? We didn't get it. Let's say it's really weak. I mean, is that, or maybe really strong? I don't even know where I'm going with this. Do you think it's going to even matter? I mean, if we get, a month ago, things were better than we thought or worse than we thought. Is it going to matter, you think?
I think at the margin, yes, because as of official data, we've got data through August. Okay. So September and October are missing. Normally, at this point in time, we'd be getting October data. Like on Friday, we would have gotten October payrolls. We didn't get that. This week is supposed to get October CPI and PPI and all that. I don't know. We probably won't get that.
And you're crushed. I mean, you're just crushed. You're like, what am I going to do on the 3rd? I know 13th is usually when CPI comes out. It's like Sonu loves the 13th. Yeah.
But September data, I think it's useful to have that data, right? Like than not. You'd rather have it, just to see in what direction is the trend going. Are they telling us the same story that private market data has been telling us, right? And it sort of sets up a nice baseline that's like the gold standard of data. What is the gold standard, right? Just to set that baseline. So I think it'll be useful. How much it matters at the margin, I don't know. But let's just take the Fed. The Fed is going to meet in December, mid-December, third week of December. At least this time, fingers crossed, they won't be flying blind going into that meeting. Okay. Right. Because we'll get November payrolls, we'll get November CPI before that, November PPI. And I think, I can't wait. You can tell I'm probably excited. Yeah, this is just like, very excited. Almost like Halloween where you take all your kids' candy. You get excited about that one. There you go. And you get to shoot off fireworks. But as Sonu said like 2 or 3 podcasts ago, it's for the kids. Like, you love getting your fireworks, shooting them off. Yeah, I want to dive in just one more thing, and we'll probably wrap it up. Along the lines of those layoffs and stuff. Every January for the last 2 or 3 years, you know what's happened? We've seen some big tech layoffs. Like, seriously, every time it's like, these layoffs in January, everybody freaks out. Everybody gets all worried. And then you see Dan Ives over there saying, no, don't worry about it. Like, anyway, and then tech does well. So we're seeing these layoffs. I think once again, be open to the idea of seeing some big high profile layoffs, I guess, as we start the year. But I guess the other thing, Sonu, a lot of these layoffs are tech. But then it doesn't go to the initial jobless claims. Is it as simple as if you're talented in the technology field, you lose your job? That's very unfortunate. Believe me, I've been fired. I've been laid off, so I know what it's like. But then you just go get one really fast. So you need to ever file for initial jobless claims. Is that some of what we're seeing? Some of it, and maybe that's not a bad economy. If you lose your job, you get one right away. Maybe it's not as bad as they're telling us, right? What do you think? Yeah, and if, like, for example, if Amazon saying we're going to lay off 50,000 people, over the next few months, it doesn't all happen in one day. Yeah. And a lot of them may get severance as well, in which case they can't apply for unemployment benefits, at least as far as I understand. So there is that piece of it too. Good point. Yep. Right. But in any case, we should see weakness, if fewer people are, even if you don't apply for unemployment benefits. Right. That means consumption is going to slow, and all those downstream impact of people not having paychecks, people not having jobs. We should see that flow into the economy. Maybe not immediately, but at least within a month or two, we should. And if that's not showing, at the aggregate level, yes, people have been laid off. Like I said, 1.7 million people get laid off every month. Right. The question is, how much does that hurt consumption downstream? And so far, not so much.
I love it. That sounds good. Well, again, give us a like, give us a follow, give us a comment. Those go a long way with the algorithms. Last week I got in trouble. I said, give us a positive comment. I'm not allowed to say that. I'm not allowed to say, so give us a negative comment, give us positive, give us neutral. No, don't listen to any of that. That's a joke. Compliance, a joke. Just give us comments. Just give us comments. We don't care what they are. Just give us comments. But I should have known better. But I said that. I led the witness. I apologize. I'm not going to do that anymore. Just give us comments. All right. Anything else you want to talk about, Sonu, before we wrap this one up?
No, I think keep an eye. I think we have momentum going for us. The Fed seems like, even if they don't cut in December, I think on balance they will cut. But even if they don't, we're getting rate cuts next year. That's a tailwind. Yep. The White House wants to keep this rally going. So don't underestimate that. Don't sleep on that, right? I think the tariff chaos is over. The Supreme Court may put a wrinkle into this whole thing. But then even if they invalidate the tariffs, we don't know when that will be, whether it be Jan or Feb or... Look, that means companies get refunds, right? That's going to boost balance sheets. So there's some positive there too. Yeah. I think there's quite a few tailwinds as we go into 2026.
True. Yeah, we did actually want to talk a little more about tariffs. Maybe we'll just put a pin in that. I mean, we'll do that.
I'm sure we'll come back there.
Yeah, we'll come back. I mean, listen, I'm not disagreeing. I think it's whatever who's in the White House. They like to say the stock market's up. I mean, let's be clear. It's not about red or blue. It's about green, as I've said before. I just don't think much of what we're doing in the United States matters for the South African stock market. The South African stock market's up a ton. Okay. I mean, I know it's some gold and some stuff, but this is a global bull market. I'm not minimizing what we do in the US because we're the US, but the rest of the globe's doing really well too, and I think it's just really important to point that out, that we get in our little bubbles and we look, our government shut down and nobody likes it. I get it all, but there's other things going on out there that are really positive. And from a globally diversified portfolio, this is about as good a year. We'll have the more numbers in 2 months, but as good a year as you can hope for. I don't think any stock market, maybe there's one or two that are down on the year. They're all higher. Now, some are up more than others. We get that. Bonds have done well. Gold's ripping. Gold's is having a really good day today. It's not done. Cryptocurrencies are volatile, but if you're in some of the big ones, they are still up on the year. It's been a really good year for investors. Hopefully you've enjoyed listening to this podcast. We're going to keep doing them. We've been saying stay overweight equity, stay overweight some of these things, and be open to the idea of a continued rally. We're not changing our tune quite yet. So again, this is episode 161. I guess winter is here. Winter's coming. I don't know what the title is. Maybe we'll come up after the fact. I don't know. Oh, the sun's getting you there, Sonu, on the YouTube channel. Look at that.
It's winter, but the sun's coming out.
The sun is getting you there down there. So, all right, everyone. We actually tomorrow will record a special one. I've said tomorrow because by the time you listen to it is day before. That's why I said the word tomorrow all slow like that. We've got a really cool guest coming on. We're not going to say who.
Pumped.
Yeah, you've seen him. If you listen to different podcasts similar to ours, he's been out there, but he is a first-time offender, as I call it, on our Facts versus Feelings podcast. So it'll come out the Wednesday of Thanksgiving is the plan. Recording a little bit early, so we don't have to worry about the podcast that week. But we've said, we're just going to do these 52 weeks a year. You guys listen to, we'll keep doing them. We'll just do some early during holidays and things, but we love doing these podcasts. We love everybody with all the feedback and different things. Facts versus Feelings, vs@carsongroup.com is our email. Let us know any questions or comments or anything. With all that, everyone, thank you for listening. Sonu, you're in the sun. That's about to blind you. You're going to get some sunglasses out very soon. You need to get a tan. Go outside with your shirt off right now. See how there's some weirdos in Chicago. You'll be one of them walking around without your shirt on, as cold as it is right now. But anyway, all right, everybody. We'll see you next week. Thank you. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.